Okay, I'm looking at the terminal right now. It is Saturday, February 7, 2026. And we have to start with the number flashing bright green. Silver has officially smashed through the $100 per ounce barrier.
It's one of those days, the kind historians will circle on the calendar. And frankly, for those of us who track the plumbing of the global financial system, this isn't exactly a surprise, but it is definitely a shock to the system.
It feels psychological. I mean, $100 is a nice round number, but looking at these charts, this isn't just another speculative spike, is it?
No.
For decades, silver was basically the poor man's gold. It was the volatile little brother that just tagged along.
Yeah.
If inflation went up, silver went up. If the dollar tanked, silver rallied. It was predictable. But this feels decoupled from all the usual macro triggers.
Yeah, it's because the narrative has fundamentally broken. We are witnessing an identity crisis for an entire element.
An identity crisis.
Yeah. Silver is transitioning from a precious monetary asset, something you stick in a vault and forget about, to a critical strategic industrial resource.
So the price action we're seeing today isn't about inflation hedge funds buying in.
No, it's about scarcity. It is quite literally physics colliding with finance.
Physics colliding with finance. That sounds great, but I mean, we've heard these shortage stories before. We heard it about lithium in 2022. We heard it about cobalt. Those markets eventually balanced out. Why should we believe silver is structurally different and not just another hype cycle?
And that is the right skepticism to have. But the difference with silver, it comes down to its chemical properties. You see, you can build a battery without cobalt. We're doing it with LFP batteries now. But you cannot transmit electricity efficiently without silver. It is the most conductive metal on the periodic table, period.
And right now, the green transition and the AI revolution.
Exactly. The two biggest engines of the global economy are built on platforms that physically require silver to function.
So our mission today is to stress test that thesis. We're going to look at the industrial burn rate, the geologic reality of why we can't just dig more. And then, and this is the part that scares me a bit, we need to unpack the paper market on the COMEX. Because if the physical world is running out of metal, then the financial contracts promising to deliver it are in very big trouble.
We are standing on the edge of a default, not a debt default, but a delivery default.
Let's start with the demand side then.
Yeah.
The narrative for years was just solar panels use silver. But at $100 an ounce, surely the solar industry is doing everything possible to use less of it. I mean, standard economics says if price goes up, substitution kicks in.
They are trying, certainly. It's called thrifting. But they've kind of hit a wall where the engineering fights back.
What do you mean?
To understand this, you have to look at the shift in photovoltaic technology. A few years ago, the standard was something in PERC cells. They were fine, but they hit an efficiency ceiling. Now, the industry has aggressively shifted to TOPCon and heterojunction HJT technologies.
Because they generate more power per square foot.
Correct. But here is the catch. TOPCon cells aren't just a little different. They are silver hogs.
Cogs.
In a PRC cell, you printed the silver paste on the front. In TOPCon, to prevent electron recombination and just maximize efficiency, you need silver passivation layers on both sides.
Wait, on both sides, so they're actually using more.
You are essentially painting the cell in silver to capture that extra, say, 2% of energy output.
So the industry pivoted to a new technology to get better power efficiency, but they inadvertently locked themselves into higher silver intensity.
Precisely. We call it the double driver effect. First, you have the sheer volume solar installations have just exploded globally. We're looking at demand exceeding 200 million ounces annually by 2028 just for solar.
That's insane. What percentage of the total supply is that?
That's roughly 20% of all the silver mine in the world, going into just one industry.
And the second driver is the intensity per panel itself.
Right. It's gone up. And unlike, say, a jewelry buyer, solar manufacturers are price inelastic. If you are a gigafactory and silver goes from $25 to $100, you don't stop buying. You can't stop.
If you stop, the factory shuts down, contracts are voided.
You go bankrupt. So at $100, they aren't selling, they are panic buying. They have become the new central banks of silver, hoarding physical stock just to keep the lines running.
Okay, so solar creates this massive floor under the demand. But reading through the source stack, the part that really surprised me was the connection to artificial intelligence.
Yeah.
I just don't naturally link ChatGPT to a precious metal. I know chips use gold and copper, but where does silver fit into the AI stack?
It's not in the chip itself, it's in the infrastructure. Think about what an AI data center actually is. It is a massive building designed to push electricity through processors as fast as possible without melting down.
Heat.
Exactly. Heat management. We've seen global IT power capacity just skyrocket. We're nearing 50 gigawatts of capacity. When you pack server racks that densely, resistance is your enemy. Copper is a great conductor, but silver is roughly 7% more conductive.
Which matters at that scale.
In the world of high-frequency trading and AI model training, microsecond latency matters. But even more importantly, silver is thermally superior.
So using silver connectors and soldering isn't just about speed, it's about cooling.
It's a thermal management strategy. If you use copper in these ultra-high-density interconnects, the resistance creates more heat. More heat means you spend more electricity on cooling. At the scale of a hyperscaler like Google or Microsoft, the upfront cost of silver pays for itself in energy savings. They aren't viewing silver as a precious metal, they view it as a high-performance industrial material.
Which brings us to the electric vehicle sector. We know EVs use more silver than gas cars. It's in the battery management systems, the contacts, charging stations. But again, I have to play devil's advocate here. If silver is this expensive, why can't Tesla or BYD just switch to copper? We do it in housing wiring. Why not cars?
Because of the environment those wires live in. A car isn't a house. It vibrates, it gets hot, it freezes, it gets splashed with road salt. Copper oxidizes. If you put copper contacts in a battery management system, which is the brain keeping the car from, catching fire, and that copper corrodes over 3 years, the car fails.
And warranties are what, 8, 10 years?
Exactly. You cannot risk a mass recall of 5 million vehicles because you save $50 on silver connectors. The liability risk just completely outweighs the raw material cost. So you have solar, AI, and EVs all fighting for the same pile of metal, and none of them can easily switch to a substitute.
Okay, so we've established that the demand is real, and it is sticky. In any normal Econ 101 class, when demand triples and price quadruples, the supply side should explode. Miners should be rushing to dig holes in the ground. So why aren't we drowning in new silver supply?
This is the supply paradox, and it's arguably the most misunderstood part of the silver market. It all comes down to geology.
Is it that we just can't find it?
No, we know where it is. The problem is how it comes out of the ground. About 75 to 80% of the world's silver is mined as a byproduct. It's an accident.
Wait, explain that. They aren't looking for it.
Not primarily. Most silver comes from mines that are set up to extract lead, zinc, copper, or gold. Let's say you run a massive copper mine in Chile. You move tons of earth to get the copper. In that dirt, there happens to be a little bit of silver. You separate it and sell it as a bonus credit to lower your costs.
So if the price of silver goes to $100, but the price of copper crashes,
you might actually shut down the mine. That's the kicker. Silver supply is inelastic to silver prices. It is held hostage by the demand for base metals. You are not going to spend $2 billion building a zinc mine just to get the silver byproduct, no matter if silver is $100 or $200. It just doesn't move the needle enough.
that creates a terrifying lag time. Even if primary silver miners, the guys who actually look for silver, want to ramp up, how long does that even take?
From discovery to first pour, 10 years minimum. Permitting, environmental studies, infrastructure. We are eating the seed corn of exploration done in the 2010s right now. There is nothing coming down the pipe to save us in 2026.
What about recycling? The urban mine. I have a drawer full of old iPhones. Everyone does. There has to be millions of ounces sitting in landfills.
There is. But getting it out is a chemistry problem, not just a logistics one. In an iPhone, the silver is used in microscopic amounts on the circuit board, often mixed with other metals or coated under plastics.
So you could just melt the phone and get a silver nugget.
No. You have to shred it, smelt it, and then use heavy chemical baths, cyanide or acid leaching to separate the isotopes. That costs money and energy. The data suggests that for urban mining to be profitable for industrial scrap, you needed silver above $30. But for the lower grade stuff, like consumer electronics, the break-even is much, much higher.
It costs more in acid than the silver is worth.
Until now. At $100, recycling will ramp up, but building those refining facilities takes years. You can't just flip a switch. So we have this hardware-hardened demand meeting a supply that is geologically constrained.
This is where we have to pivot to the financial side. Because everything we just discussed, atoms, mines, solar panels, that's the real world. But the price of silver is largely discovered in the paper market, specifically the COMEX. And this is where the squeeze part of our title comes in.
This is the battlefield. The COMEX is a futures exchange. It was designed for hedging for a miner to sell their future production to lock in a price. But over the last 30 years, it became a casino for speculators.
And it's highly leveraged. I saw a stat in our research that in early 2026, the paper-to-physical ratio was estimated at 356 to 1. What does that actually mean?
It means that for every single ounce of silver sitting in a registered vault, there are 356 claims of ownership traded on paper.
That sounds like a Ponzi scheme.
It's fractional reserve banking applied to commodities. It works fine as long as everyone agrees to play the game. Usually 99% of traders don't want the silver. They're hedge funds or algo traders. When the contract expires, they just settle in cash.
But the game stops working when someone actually wants the metal.
Correct. And this is where we need to distinguish between the two types of inventory in the COMEX vaults, eligible and registered. This is critical.
Break it down for us.
Eligible silver is metal that meets the purity standards and is sitting in the vault, but it's privately owned. It is not for sale. It might belong to a family office, a sovereign wealth fund, or a solar manufacturer. It's just parked there.
And registered.
Registered is the metal that has a for sale sign on it. This is the dealer inventory available to satisfy the futures contracts if someone stands for delivery.
And what has been happening to the registered category?
It has been bleeding out. As the industrial users panicked, they started buying up the registered stock and moving it to eligible, taking it off the market, or physically loading it onto trucks and shipping it to factories. We are now at a point where the registered inventory is dangerously low relative to the open interest, the number of active contracts.
So walk us through the nightmare scenario. A run on the vaults.
Yeah.
Let's say I'm a big industrial buyer. I hold a long contract. It expires. I say, I don't want cash. I want my silver. What happens?
That is a delivery default. And the exchange has a rulebook for this. It's not pretty. They can declare force majeure.
The legal act of God clause.
Basically. But in this context, it allows the exchange to change the rules of the game mid-play. They can implement liquidation-only trading. This means you are literally forbidden from buying new positions. You can only sell.
Which artificially crushes the demand side on the screen.
Exactly. They can also hike margin requirements to 100%, forcing leveraged speculators out. But the nuclear option is forced cash settlement. The exchange simply says, we cannot give you the silver. Here is the cash equivalent at the closing price of $100. Contract closed.
But if I'm a solar manufacturer, I can't build a panel with a check. I need the metal.
And that is the moment the market breaks in two. You get bifurcation. The paper price on your screen might be stuck at $100, but the physical price, what you have to pay in the real world to get a bar, might be $150 or $200.
And we are already seeing the tremors of this. The notes mention that in Shanghai and Dubai, the premiums on physical delivery were running $30 over the spot price earlier this year.
That's the arbitrage closing. The East China specifically is draining the West of physical metal. They are paying the premium because they need the commodity. The COMEX price is becoming increasingly irrelevant.
That dovetails perfectly into the geopolitical angle. China implemented strict export restrictions on January 1st, effectively classifying silver as a strategic commodity.
This was the wake-up call. China dominates solar panel manufacturing and refining. By restricting exports, they are essentially saying, we are keeping our natural resources to support our value-added industries.
And the U.S. response?
Reactionary. We added silver to the critical minerals list, but that's just paperwork. The real action is in the corporate boardrooms. We're seeing the death of just-in-time inventory.
Yes, stockpiling.
Aggressively. And they are bypassing the COMEX entirely. We're seeing direct offtake agreements. Tesla, Samsung, major solar conglomerates, they're going directly to the miners. They're saying, we will fund your mine expansion, but we get the first 50% of everything you pull out of the ground.
They are vertically integrating, treating silver mines like their own power plants.
It's the only way to guarantee supply. If you rely on the open market, you are exposed to the squeeze. If you own the mine, you own the metal.
So for the listener who's sitting here thinking, okay, this sounds incredibly bullish, we need to look at the investment landscape because betting on silver is historically painful. It's called the widowmaker trade for a reason.
It is. The volatility is stomach-churning.
Let's talk about the gold-to-silver ratio, the GSR.
Right. It simply measures how many ounces of silver it takes to buy 1 ounce of gold. Geologically, in the Earth's crust, the ratio is about 19 to 1. Historically, it hovered around 15 to 1.
And in 2020, it blew out to 125 to 1.
Which was absurdly cheap. Now, in 2026, we've compressed down to roughly 57 to 1. But if this industrial thesis holds, Many analysts believe that ratio should head back towards 30 to 1 or even lower.
And this is where the gold squared effect comes in.
Yes, the silver market is tiny. In dollar terms, it is a fraction of the gold market. If even a small percentage of global capital decides to rotate from gold into silver, it's like trying to push water from a fire hose through a garden straw. The pressure builds instantly.
But how do you actually play it? Because if the COMEX is broken, buying a paper ETF seems risky.
It depends on what you are trying to solve for. If you just want to catch the price swing in your 401k, an ETF is liquid and easy, but you have to understand the counterparty risk. As we discussed, if the vaults run dry, the ETF will likely settle in cash. You get the profits in dollars, but you don't own the metal.
And if the dollar's the thing crashing, getting paid in dollars doesn't help much.
Exactly. That's the argument for physical possession, coins and bars, but the friction there is high. You pay a premium over spot, sometimes 20–30%. You have storage issues. It's illiquid.
There's also the tax implication in places like Europe, where VAT eats into your gains immediately.
Right. There is no perfect vehicle. But the smartest money right now seems to be bifurcating too. Keeping some liquidity in paper for the short term, but securing physical for the long-term insurance policy.
I want to wrap up with a thought on price targets. I've seen everything from it crashes back to 50 to it goes to 200.
The $50 bear case assumes a global recession so deep that people stop buying cars and solar panels.
Which is possible.
It is. But governments have shown they will print infinite money to stimulate the green economy. So demand is subsidized. The $200 bull case is simply math, based on the gold to silver ratio returning to historical norms. If gold is $3,500 and the ratio goes to 30 to 1, well, you do the math.
It's well over 100.
Easily.
So, to summarize, we have an asset that is essential for the future of energy and computing. We have a supply chain that is geologically slow to react. And we have a financial market that is leveraged 356 to 1 against a shrinking pile of physical metal.
That is the state of play.
It feels like the game of musical chairs is finally stopping.
And there are about 300 people trying to sit in one chair.
I want to leave you with this thought today. We obsess over the price. We watch the ticker. But if we enter a scenario of true force majeure, where the exchanges fail to deliver, the price on the screen becomes a fiction. At that point, the only thing that matters isn't the value of the contract, but the possession of the asset.
In a crisis of scarcity, possession is the only price that matters.
On that cheerful note, we're going to sign off. Keep your eyes on the physical premiums, not just the spot price. That's where the real story is. Thanks for listening to The Deep Dive.
Stay pure.